welcome everyone to today's session. Today's session is on property and investments for US Australian expats. There's some really unique tax and other financial considerations for US Australians when investing in property and other investments. So we're going to delve into some of those today and try and demystify some of the concepts as much as possible. We're joined today by the gurus of US Australian tax. So we've got Khandra Wong, who is a Australian-based US tax expert. Welcome, Khandra. How are you doing today?
Very well. Thank you, John. Thanks for having me.
Great to have you. And we've also got Brad Murphy, who is an Australian expat tax lawyer and accountant. Hey, Brad, how you doing?
Good, thanks, John. Thanks for having me as well.
Good to have you on board today. So just going through some of the formalities. So as with all these financial sessions and webinars, today's session is general in nature. You shouldn't consider this personal financial advice for yourselves. We haven't considered any of your personal circumstances in presenting this webinar today. If you are looking for personalised advice, please reach out to one of the panelists today or another suitably qualified professional. You will see a Q&A box at the bottom of your screen there. So as we go through the session today, please feel free to ask any questions along the way. We'll endeavour to answer as many of those questions at the end of the session. Anything we can't get to, we will try and come back to you via email potentially if we can, but otherwise we'll give you the method to communicate with any of the co-panelists to ask any questions directly and potentially receive some personal advice. And also just noting that today's session is recorded. So if you do need to take off early, you'll get an email in the coming days with the recording of the session. So that'll come through via your registered email. So just to introduce ourselves a little bit further, so I'll throw over to Brad just to quickly introduce himself and talk about his experience and his firm.
Yeah, thanks, John. Yeah, so we're a specialised Australian international and expat tax firm based in Melbourne and Sydney. We have a particular niche or expertise in the Australian and US system. So it's a real focus of ours, looking after US and Australian clients in both countries. And we partnered up with Khandra and John to give integrated tax and financial planning advice across both countries. And yeah, it's great to be on here today and looking forward to helping everyone.
Beautiful. Thanks for that, Brad. And then we've got Khandra, who's a US tax specialist based here in Melbourne. So Khandra, do you want to introduce yourself and your company and how you work with your clients?
Yeah. Hi, everyone. Good morning. I'm Khandra, and as John mentioned, I am based here in the western suburbs of Melbourne. I work with anyone that has a US tax connection. So people going to the US on E3 visas, people coming back from the US, green card holders, US citizens. It really runs the whole gamut. I have a small firm here focusing on sort of boutique and very individualized services for clients, working together a lot with Brad and John just to make sure that everything is running smoothly on both sides of the pond, so to speak.
Great. Thank you for that, Khandra. And to introduce myself and Apt Wealth Partners. So Apt Wealth Partners, firstly, is a Australian-based financial advice firm. So we've got offices in the Melbourne and Sydney CBD. We've got around 80 staff, and we manage on behalf of our clients just under $3 billion on behalf of our clients in wealth portfolio assets that we directly advise upon and make recommendations on. I head up our expat services team, which is a specialised team that sits within Apt Wealth and specialises in assisting individuals with cross-border tax and other financial considerations. But predominantly it's US Australians that we specialise in. And as you're about to see, there are some really unique things that you need to know when looking at US Australian taxes that we've got a lot of experience and expertise in navigating. So, and as Brad and Khandra both alluded to, we do partner up with Brad and Khandra to deliver a really consolidated, holistic tax and financial planning service to our clients. So this stuff is, as you're about to see, if you weren't aware already, you're going to see in this session, this stuff is really complex and it does require really specialized advice from all professionals, and you know, if one professional isn't across this stuff, and they're recommending something that, you know, may work from a US perspective or it may work from an Australian perspective, it often doesn't work on the other side. You know, there's some really common Australian financial strategies, for example, that make sense from an Australian tax perspective, but can be a complete disaster on the US side, and vice versa. So if one of your professionals aren't across this, it can be, you know, really damaging and complex, and it can unwind some of the good work of the other professionals. So Brad, Khandra, and I work super closely together with our clients, delivering a really holistic service, and we speak to each other most days. You know, we collaborate with our clients, so our clients don't have to be the middle person. We can come to our clients with a consistent holistic strategy, and we can share information with our clients' permission to make sure that you know, everything is as seamless as possible. So Brad and Khandra, do you want to add anything to that and how we work together, or
Yeah, I think that's a great summary, John. I think, yeah, I think I'll just add, it's obviously really important to have sort of integrated and consolidated advice on both the US and Australian side. I think the way the two systems interact from a tax perspective and financial perspective, it is really important to have, I think, advisors that understand both systems and, yeah, can work together on your affairs as a bit of a one-stop shop.
Yeah, perfect. So we'll kick into the session now. So firstly, going through Australian property. So over to you, Brad, to take us through some of the tax treatment of Australian property for US Australians.
Yeah, thanks, John. Yeah, I'll kick off on the Australian tax side, and then I'll let Khandra jump in on the American tax side. But it's obviously a big topic and a complex one as well. It's definitely at the forefront of most people's minds in terms of their move to the US or from the US back to Australia, what to do with their property. And I think you know, I think as a broad concept, basically expats of Australia get hit with higher taxes as opposed to Australian residents. And there's really two key reasons why that's so. There's basically the loss of two exemptions for Australian non-tax residents, and they are the main residence exemption. If you sell your former Australian home as a non-resident of Australia, you don't get the access to the exemption anymore. And the second one is loss of the 50% discount on the investment property side. So I think as an overall comment, really important, particularly with your main residence, to try and avoid selling that property as a non-tax resident. So if you can plan on either selling that before you leave Australia or hold it until you come back to Australia and sell it as an Australian resident, therefore you will get access to that main residence exemption, which is really important. I mean, on the main residence side, you do have the option, you can rent out your former main residence for 6 years and get the exemption in full. So that's a really important thing to bear in mind, that you can, you know, move to America, rent out the property for 6 years, and as long as you come back to Australia and sell it, you'll still get the exemption in full for that entire 6-year period, which is quite advantageous and important to consider. The other point too would be that the ATO has also brought in a 12.5% withholding tax now on the sale of Australian property. So if you're a non-tax resident of Australia and you sell effectively any Australian property, there's normally a 12.5% tax that applies at the settlement date on the property. Now, you can alleviate that by being an Australian resident or getting a variation with the ATO to have that lowered down. But yeah, just make sure you get advice around that as well. I think it's also important, and Khandra will jump in a second, to consider the American rules around your main home as well. But I'll let her come to that in a second. But if you look at the investment property side as well, the other key point for expats is the loss of the 50% discount on your investment property as well. So as everyone probably knows, with an investment property, you would get that 50% discount as an Australian resident. If you're a non-tax resident of Australia, you don't get that 50% discount. So also just factor that into your planning as well. The other point would be that you know, on the rental income and losses, any rental profit on the property will be taxed at 32.5% on the profit in Australia still. The losses can still be carried forward indefinitely, so negative gearing can still apply if you're a non-resident, which is obviously pretty common at the moment with interest rates and land taxes and whatnot being quite high. So if you do have a loss from that property and you're an expat living in America, you can still benefit from that because that loss can be used to offset any income you have from Australia down the track from, employment income if you move back to Australia, or if you sell the property down the track. So yeah, definitely still not lost. I think just be mindful, land tax rates in Australia have also increased quite a lot in recent times, especially Victoria, which is quite, topical at the moment. So I think just factor that into if you've got your former main home that's gone from a main home to an investment property, land tax will apply from that point, and it can be quite a hidden and costly cost to budget for. Yeah, I might let Khandra jump in on the US side.
I think on that point too, I think it's fair to say we've probably seen an increase in ATO, or sorry, the State Revenue Office looking into land tax. Whereas perhaps in prior years, it wasn't something that was really on their radar. Is that fair enough to say, Brad?
Yeah, I think that's a really good point, Khandra. I think certainly through data matching of the various state revenue offices and the ATO, they are matching up now. If you've got any rental income on the Australian tax return from when it's been rented and you haven't paid land tax, I think they're been a bit more stricter in sending out assessments in that regard and applying penalties too. So yeah, I think that's a great point, Khandra. Just make sure that from the date the property is first rented, that you have registered with the revenue office in your state to pay your land tax.
Yeah, and just a couple of really key points just to reiterate there on the Australian tax side of things is that if you're an Aussie, likely to be permanently moving over to the US, or going to be spending a really extended stay over in the US, your primary residence in Australia is a really key point. That if there's a good chance you may sell that whilst you're overseas, there's consideration of selling it before you leave Australian shores, because the tax treatment is very different if you sell it as a non-resident for Australian tax on your former primary residence. You won't get that exemption for capital gains anymore as a non-resident. So that's something really, and if you kind of come back to Australia, then it's potentially waiting until you trigger the tax residency again to sell that on a primary residence. As Brad mentioned, there's a 6-year carry forward, potentially on an Australian tax side of things, and they will recognise prior period of time that it was your primary residence if you sell it once you're back in Australia again. So that's a really important consideration.
I think just quickly, just on that too, John, I didn't really touch on it before, but if you come to Australia with US property, that's another big issue we see. I'll just quickly touch on that as well. That's normally good news on the Australian side. So if you're a US taxpayer, you've got a US property that's your US home, and you come to Australia and sell that from Australia, that's normally good news. You can still apply the Australian main residence exemption to that US property for 6 years after it's first rented, on the basis you haven't got another main home in Australia. But assuming you've got the one US residence, you can nominate that as your main residence in Australia. So you can sell that normally tax-free in Australia. And secondly, that US property also gets rebased to its market value when you come to Australia. So if it's an investment property, then you only pay Australian tax on the increase in the value of that property after you've moved to Australia. So it's normally good news having US property coming to Australia from the Australian tax side. But just be mindful of the American side as well, which Khandra will talk you through now.
Yeah, so over to you, Khandra, on the US side of things.
Thank you. Thanks. So I guess to preface this particular slide, we're mostly talking about US citizens or green card holders who have property really anywhere in the world. But do be aware, it can apply to you if you are an Australian who is living in the US and a tax resident of the US. So to sum it up, the US view of a principal place of residence is the taxation is very different than the Australian point of view. And I think that can be really shocking for US citizens who have lived in Australia for a long time and who are expecting a tax-free outcome when they sell their main residence, just like their neighbors or their family members have had. But for US citizens and green card holders or tax residents, The US, unfortunately, is not so generous. So they will offer the first $250,000 of capital gain tax-free, as long as you have lived in and owned that residence for at least 2 years in the 5 years prior to sale. If you are a US citizen who is married to another US citizen or US person, that does double to $500,000. But if you're perhaps married to an Australian or a single individual, you're stuck with $250,000. On the next slide, we'll run through a quick example of how the calculation will work, but I think implicit to this idea is the concept of exchange rates as well, and we'll touch on that in a moment. And another weird quirk that I just want to mention, because it has come up very rarely, but it has come up. Just bear in mind that from a US point of view, when we talk about sale of a residence or sale of a property, we are talking about the settlement date, where oftentimes in Australia, you're talking about the contract date. And so I have seen issues where taxation might arise in one calendar year for Australian tax purposes, but not until the year after for US tax purposes. So I think you can start to see really just how complicated this can all get for what should be a really simple transaction to sell your main residence. So yes, as I mentioned, this does apply to a home that is in Australia. It could be a home in the US. It could be a home anywhere. These rules apply to any US citizen, green card holder, or tax resident. On the slide here, you will see if you are a homeowner, so your main residence, you do have the ability to deduct the interest that you pay on your home loan. So not the principal repayments, but the interest that you pay. And up until about 5 or 6 years ago, that could be very lucrative, particularly if you were living in the US with a lot of US income. However, due to tax changes that took place in 2018, we don't see a ton of benefit in this area anymore, although tax laws are always constantly changing. But so we could see it become more valuable in the future. But I think that illustrates sort of a fundamental mismatch or difference between the two countries, that in Australia, you can't deduct your mortgage interest on your main residence, but you also don't pay tax when you sell your home. On the US side, you do have the ability to get a tax deduction on a year-on-year basis, but you potentially do have capital gains tax to pay when you sell. So John, if I can get you to go to the next slide.
Yep.
We'll talk about, we'll just run through a very quick and simple example that just illustrates the impact of exchange rates. So really what we're getting to on this slide here is the idea that when we're calculating the taxable gain for US tax purposes, we look at the exchange rate when you purchase the home and convert it to USD using that spot rate, versus when you sell the home, we would take the foreign exchange rate on that date, which is called the spot rate, and convert it at that date. So then we take the sales proceeds, subtract the cost basis, and that's really what gives us the capital gain from a US point of view. So just really quickly running through this example, you can see what a difference the exchange rate does make. So if you had purchased a property for the equivalent of 513,000 US dollars, the answer is very different if the exchange rate goes up to 1.52 and you're, realizing $650,000 of sale proceeds. Taking $250,000 of your exemption into account there, not a problem. You don't have a taxable US gain. But of course, if you're house is really appreciating in value if you've been lucky enough to have property for a long time in Australia, particularly in Sydney. You know, it doesn't matter what the exchange rate does, even if it goes the opposite direction, it's the value of the gain itself. Even if we deduct $250,000, you can see that if your property's worth 1.1 million, you'd still have quite a large capital gain to pay in the US. Certainly, it's cold comfort, but that gain is taxable at the capital gains rates in the US, which are better than ordinary income rates. So between 15 to 20% tax in the US, and potentially a 3.8% net investment income tax on top of that. So very different outcomes than what you might have been expecting in Australia.
Yeah. So that, and to key point, and on that topic of foreign exchange, Khandra, and you know, we'll talk about currency a little bit later in the session as well. It's super important from a US Australian perspective, of course, but
yeah,
this weird concept of you know, an Australian property loan and repayment of that loan, and potentially a tax that may be due.
Yeah.
In certain circumstances. Do you want to maybe run through how that can potentially play out?
Yeah, this one has a bit of a sting as well. So I guess this is the IRS having the idea that if you took out a loan in a foreign currency and at some point repaid that loan or extinguished that loan, the idea that foreign currency gain would be taxable in that situation. So I always think of it as, okay, if I take out a loan today and in 10 years I pay it off with fewer US dollars, the US will look at that and say, hey, you got a discount and we're going to tax you on that discount. On the other hand, if I took out a loan and paid it back with more equivalent US dollars, they'd say, oh, too bad for you. You don't get to deduct the loss. So a lot of other countries do have foreign currency gain rules. Australia has similar rules itself, but a lot more generous with the deductibility of the loan. So yeah, it's just something to watch out for. And this one is very tricky because you might have a good idea of which way property prices are heading in Australia, but I don't think anyone has the crystal ball that will tell you what foreign exchange rates are going to do in Australia. So that can, you know, make the idea of taking out a mortgage in Australia a lot more difficult. So, you know, if you're lucky enough to have a partner, you know, we can sort of work through different scenarios by having debt in one person's name and not the other. But, you know, if that's not your personal situation, it can, I guess, just provide another level of risk of US taxation and another level of complexity that can arise.
Yeah, it's a nasty one. But another thing which can work reasonably well is offset accounts. That's something that is really unique in Australia, and you know, it's not ideal. You know, sometimes you want to get rid of the debt. You know, it might be holding you back from doing other borrowing, but you know, if you do have a lump sum that comes in, and you know, you want to reduce the interest that you're paying, an offset account can help in this sort of scenario where you can basically offset the debt, not make the repayments anymore, and not have this nasty issue. And then when the exchange rate is more favorable from this calculation perspective, then potentially getting rid of the debt at that stage, that may work in limited circumstances, but it's something that you need to be careful of. So any other things on the US Australian property side, guys, before we move into other types of investments to factor in or think about?
Yeah, I think just to follow on from that topic, I mean, that's a really key point for the example there that Khandra spoke through, that obviously your Australian main home is normally always exempt from tax, right? If you're an Australian resident, you know, when you sell it. But as Khandra sort of pointed out there, like the US can tax it if it's over those thresholds there. So there can be some planning there to think about, is it an option to have that property in the non-US spouse's name? If that's an option, of course. That does, of course, come with other sort of complications in terms of, family arrangements and mortgages and whatnot. But from a pure tax lens, that's normally a good option, just to keep it outside the US tax net on sale as well.
Yes.
So, yeah, I think just make sure you get some advice before you do purchase a property in Australia.
Yeah. I'll quickly mention as well, in these scenarios, we talked a lot about US citizens, green card holders. We do sometimes come across Australian tax residents who otherwise have no connection to the US at all. They may have bought a vacation home in the US, or maybe they lived there for a period of time and moved back to Australia. The US does have a concept of withholding tax for non-residents as well. So if you're a non-resident of the US and you're planning on selling a property, you really need to get specialized advice and help. There's a lot of paperwork that has to go in with very specific deadlines. And you want to make sure that you're working with the buyer and the buyer's agent as well to make sure that that process goes smoothly. And depending on what state the property is located in, there could be state withholding tax requirements as well. So something to keep in mind if you're not a US resident.
Yeah, some really good points. Absolutely.
Definitely.
So just more broadly, in terms of selecting the right investment for you as a US Australian taxpayer, there are a lot of things to consider. I mean, at the best of times, if you were just worried about one tax system, it could be complex. But when you add US Australian taxes and you've got to think of this dual tax liability, it gets a little bit more complex. So just really quickly, just going through some of the things to consider. Your risk tolerance and stage of life. That's every investor around the world needs to think about that, because ultimately, how much risk you're willing to take on. Anytime you are investing, you're taking on some risk. So how much you're prepared to stomach, and that is the fluctuation of asset prices and how much you're prepared to risk as part of that process. Everyone's different. Generally speaking, as you get towards retirement, people tend to take on less risk compared to if you have a 20-year time horizon before you need to utilize the asset. So as a general rule, this isn't always true, but as a general rule, people have 20 years before retirement, they may be a little bit more of a risk taker versus someone in retirement who is looking to protect part of their asset portfolio and may take on less risk. But everyone's different, and we work with our clients to assess what risk tolerance you're willing to take on and allocate the assets accordingly. Access to capital is a really important consideration. So if you need to access capital within say 12 months to fund a holiday or you need to fund retirement and you need access to capital, that's going to dictate what sort of assets you might be looking to purchase. For instance, if you were looking to do one of those things within 12 months, you're probably best to just keep it in cash or some other very liquid, stable type investments. But, if you've got a 20-year, 15-year time horizon before you need to access the asset, then an investment property may make sense. So just thinking through when you're going to actually need to pull the capital of the investment to determine what the most appropriate asset class is. Navigating taxes, of course, we've alluded to the property side of things. We'll talk about the share side of things in a moment, which is very complex as well, and it is different for US Australians. So we'll go through that in a second. The fourth point on your screen there is really important. What's your purpose for investing? When and where will these goals take place? So usually when you're investing, it is for a future goal in mind, be it retirement, buying a house, if it's for, helping your kids through education, leaving a legacy, whatever it might be, there's a goal in mind that we're thinking about when investing. When and where that goal takes place should have a big bearing on what sort of assets you should be purchasing and where you purchase those assets. It sounds simple, but sometimes people get it wrong in terms of selecting the right assets to really match yourself with what's going to be the best asset to help you achieve those goals. And it kind of dovetails into that last point, which we'll talk about a bit later on, the currency exchange risk, which is super important as well. So, if the goals are going to be in Australia, then it potentially makes sense to have a good portion of your assets in Australian dollar terms, and vice versa. If your goals are going to be back in the US or in the US, it probably makes sense to have assets in, or a good portion of your assets in US dollars, because as Khandra mentioned, trying to predict what the exchange rate's going to do in any time frame is really impossible. So that's something that the currency exchange risk, and US Australians certainly have to think about that as part of their thinking when selecting assets. So now on the share side of things, firstly going through the Australian tax treatment of shares, and essentially there's a big difference between being a resident for Australian taxes and a non-resident for Australian taxes. So as opposed to property, which if you have an Australian investment property as a non-resident for Australian taxes, shares are actually treated more favorably, because say that you're living in the US, and you're a non-resident for Australian taxes, and you go and buy shares either in Australia or the US. Typically, the capital gains on those shares for the period of time that you're a non-resident aren't assessed for Australian taxes. So the day that you return to Australia, that's when Australia is going to, and you trigger the tax residency again, that's when Australia is going to look at it and say, okay, we don't care what happened prior. It could have increased at any value. The day you return is when they're going to assume, in the eyes of the ATO, that you've bought that investment. And then it's any gains from there forward that will be assessed. Now, from a resident perspective, as with any other capital asset, it's 12 months of owning that asset. Anything beyond that, you disregard half the gain, and half the gain is taxed at your marginal tax rate. So from a non-resident perspective, there is a really unique opportunity for especially Australians living in the US, especially if you're on a temporary visa. There can be some amazing opportunities to invest in equities, wherever they may be, in the world, US or Australia. If you're on an E3 visa living in the US, get advice around this, because there may be some reasons why this may not apply, but there may be an opportunity to actually get some tax-free capital gains if you don't sell whilst you're in the US, and you sell when you get back to Australia. That portion of the time that you're a non-resident for Australian taxes, you're a temporary US resident. If you wait until you exit the US tax system, re-enter the Australian tax system, there's circumstances where there may be some tax-free capital gains. But again, get some advice around that, because there's circumstances where that may be complicated. But so in terms of income taxes, again, very favorable on dividend income in Australia. So fully franked shares, when you're a non-resident, you don't get the franking credit, but then you're also not taxed on the actual dividend itself. And unfranked dividends are taxed at up to 15% for US tax residents, because of the treaty between the US and Australia. So quite favourable in terms of the assessment. The resident tax side of things, ultimately, it's just marginal tax rates. It's just going to be treated as income. So dividends, like any other income you're receiving, be it rental income, employment income, is taxed at marginal tax rates. So there are some really good outcomes on the Australian tax side of things. Now, there's some considerations on investing in Australia as a US taxpayer, which we'll go through. But basically, there's some technical definitions of what a passive foreign investment company are on the screen there. But essentially, it's any non-US exchange traded fund, managed fund, or anything that's not a very direct investment that's domiciled outside of the US will typically trigger this treatment, and won't go into the nitty-gritty of it, but it typically will lead to more complicated US taxes and extra reporting on a US tax side of things. So some examples of what would trigger this treatment. Now, this is anything domiciled outside of the US. Now, the US typically won't have a problem with what you do in the US. Any US investments, any ETFs that are US domiciled, typically no problem from this perspective. But it's any so if you were investing in Australian domiciled exchange traded funds, so, a Vanguard Australian share fund, for example, is a popular one. Stapled securities are ones that, can often be seen to trigger this treatment. Transurban is a company that is a stapled security that you've got to be careful of. Listed investment companies, so not quite as popular as they used to be, but Argo, Australian Foundation Investment Company, are ones that are very popular. A managed fund or mutual fund that's domiciled outside of the US, that one is another one that can trigger this treatment. And real estate investment trusts, or REITs as they're known, A-REITs as they're known in Australia. These are property trusts that are often available through the Australian Stock Exchange. They're often problematic from a US perspective just because of their composition. Anything to add on that, Brad or Khandra, on the PFIC treatment or consideration? Oh, I've got a few other things to go through, but anything on the technical US tax treatment?
Yeah, I think that's a really good summary. I think this issue comes up, it can really catch you off guard. It's something so simple and normal in Australia that shouldn't really be a big deal, can really have some unintended consequences. So, something we run into a lot is, just using those apps on your phone that sort of round up every purchase that you make. I won't mention what they are, but they invest, the difference that you pay on your morning coffee every day. Typically, they're going to invest it in 6 or 7 different PFICs. So you might have $400 or $500 saved up in this tiny little fund, but then have to do 7 different tax forms with your tax return every year. It gets really expensive. So yeah, unfortunately, US citizens and green cards really have to watch out for this issue.
Yeah, robo investing. I think
yes.
you're mentioning there, Khandra, which it's probably not fair, and and with those apps as well, what they often will do is that they will change through the year as well. They'll flip, sell one ETF, buy another one, and that sort of compounds the problem as well. So that's something to be careful of. How do you avoid this treatment if you want to, when you're investing from Australia, or as a Aussie living in the US? So very direct company stock will typically get around this treatment. So that's what we often do at Apt Wealth, with a lot of our clients is, if they're wanting to keep the money in Australia and invest as a US taxpayer, buying very direct company stock, and not recommending these particular companies, but things like Commonwealth Bank, Telstra, CSL, those sort of companies. If you buy those, they are completely fine. US domiciled exchange traded funds. Now, there's a couple you can get on the Australian Stock Exchange that are actually, be very careful with this. It doesn't mean that you are buying, just a US share ETF. It's going to be actually domiciled. The ETF has got to be domiciled from the US. They're usually asking you, they're withholding tax. The IRS are withholding tax and asking you for a W-9 or a W-8 Ben form as part of this. So there's a very, very select few that qualify for this. So be very, very careful and look at that.
Yeah,
they are okay, but 99% of the ETFs that you can buy on the Australian market are problematic from this perspective. And you can invest in the US as well. So as I mentioned before, the US has no problem in what you do on a US exchange or US soil. They're all completely fine from a US tax standpoint. So that is a solution for you. But thinking of that, if you're looking at this and going, well, you just invest in the US, there's no reason why you would invest in an Australian market. That can be a consideration, but there is the currency exchange risks. Now, if you are, as I mentioned earlier, this stuff is you're not going to predict what the exchange rate's going to do. And, there's, if you're, let's say you're a US citizen living in Australia, and you solely invest in the US market, what you're doing right now is that you're going to send money from Australian dollars into the US, converting at the current exchange rate. And if you need to use that money back in Australia again at some point, you're going to need to send the money back to Australia. So what the exchange rate does between now and when you send the money back is going to have a big say in what the eventual Australian dollar return is going to be on that investment. Good or bad. It can go either way, but it does add an extra layer of risk around your situation. Now, it doesn't mean to say that you shouldn't use some money into the US market, because ultimately, if you look at every super fund around Australia, they are investing money into the US market. It's the best market in the world. Everyone probably should have some exposure to US and international equities. We're a small market here in Australia, so it's not, it probably wouldn't be a strategy to just put everything into Australian dollars in your holistic financial situation. But it's also probably not the thing to do to send everything back to the US and convert it to US dollars, because, if we saw this scenario, there was a scenario that we can see here on the screen from 2007 to 2015 or so, where the Australian dollar was really elevated. If that played out again, the investment performance, the underlying security may do really well, but if the exchange rate moves in the wrong direction, then your actual investment return may not be wonderful. So it's thinking about things holistically. Yes, you want to simplify, you want to invest in certain investments, but we've got to think about managing all the risks around your situation and making sure that we don't expose ourselves too much to some of these issues. So it's thinking about, just in terms of share strategies, we mentioned about potentially waiting until you come back to Australia. If you're a temporary US resident, there can be some advantages from a capital gains tax perspective. It's also, you would need to have a very good reason to want to invest in a PFIC, the passive foreign investment company. The investment performance would have to do exceptionally well to justify the extra cost and tax treatment. So you probably want to steer clear of a PFIC, and then think about tax and currency exchange, of course, which we've mentioned. So
I think just one important point, John, is for Aussies going to the US, which we haven't touched on, would be there is a exit tax that applies when you normally cease to become an Australian resident on the shares you own. So that applies to shares, crypto, so basically any investment you own, right? And normally you'd sort of be liable for that exit tax when you leave Australia. But you can defer that. And under the treaty with America and Australia, it's quite advantageous in that if you sell those shares or crypto from the US, right, you just pay US tax and not Australian tax on that disposal. And that's actually quite important, right? Because it can be quite a disadvantage to have sort of shares as a non-Australian resident. So that tax treaty outcome is quite a good one that often overlooked in practice. I think the other point too is to think about what investments you have in Australia before you leave the US and what structure they're in. If you've got an Australian family trust, for example, or self-managed fund, that you need to get advice around that, because it's a bit sort of trickier to manage, because that exit tax won't apply to the family trust in Australia, but the trust would need a director that's an Australian resident, and same with the self-managed fund, for example. And that's probably a big topic for another day, the US treatment of super funds. But there's actually a webinar we did a few weeks ago on that topic. So anyone can have a look at that webinar if you're keen to learn more about US Australia retirement planning. But I think just bear in mind that exit tax planning is quite important. And the other point too would be, as John and Khandra mentioned, there are some definitely upsides coming back to Australia with shares, because you end up normally just paying Australian tax on the gain. And that's, quite advantageous if you've got, employee stock that's vested, from the US, and you're sitting on quite a large gain, for example. You can normally sort of mitigate some of that gain as well.
Yeah, I think adding on to that topic of exit tax, so if you're an Aussie who's going over to the US, a really big consideration there is state income tax as well. So if you're going to a no income tax state like Texas, Florida, Washington State, no problem, because the treaty exists at the federal level, and you can defer the exit tax. If you do pay tax in Australia, we have foreign tax credits. We can always mitigate or eliminate the double tax. Your states like New York, New Jersey, California, all the places that Australians really love to go when they move, they don't necessarily conform to the treaty. So you could have a tax situation where you've got, let's say, Australian rental income or Australian dividend income coming through, which is fine on the federal point of view, but is taxed at state level, and there's nothing we can do about that. So that's a well and truly a case of double tax there.
No, they're really good points, and that pre-departure planning is so important. Once you've landed on US soil, it's often or it can be too late in certain circumstances, or it's going to really complicate your next moves. So certainly reaching out for any Aussies moving over to the US, because you wouldn't think it with some of these things, but they can be really cause issues on the US tax side of things, unfortunately. And Brad, that's a really good point about the capital gains tax deferral, which is not super known out there. But there can be some really good advantages in potentially utilizing that in certain circumstances. So any other points, guys, before we go into the Q&A? Covered a bit of ground there.
Yeah.
So, which is great. So we've had some questions come through on the Q&A. Please feel free to keep sending them through. We'll get through as many as we possibly can, but might just want to work through a few of these here. So maybe should we start with Danielle's one at the top there, about potentially purchasing so if you're a US citizen living in Australia and earning US dollars, potentially buying a US property. Interesting one, potentially on the Australian capital gains tax side of things. I think we were discussing the other day, guys, about how that may impact your Australian tax if you're buying from here, purchasing a US property. Do we want to maybe go through?
Yeah, I'll kick it off. I'll kick it off if you like, and then Khandra can jump in on the tax side. But I think certainly quite common for US clients in Australia to purchase US real estate as an investment property. It would just mean that the rental income, the profit would go on the Australian return with the credit for what you paid to America. Likewise, when you sell that property, just be aware that Australia would tax the capital gain, but because it's US property, you get a credit for what you're paying to the US. So the US would always tax US property before Australia, but the upshot of the treaty is that there's no double tax there. So that's not a bad outcome. I mean, in terms of getting leverage in terms of home loans to buy the US property from Australia, that's a fantastic question. Maybe John can jump in with that one.
Yeah, it's really going to be done by a US institution. So because an Australian institution, they're not going to lend for a US property typically. Even though you're here in Australia, it's usually going to be done through a US institution, and it can be really quite complex for you to borrow cross-border borrowing. It can be really complex because often the way it works is that they will look at your Australian debt, but because any institution will want to have the collateral to borrow against, it gets quite complex. So you really need a specialist either in the US. So if you're buying in the US and you need a specialist on the US side that's going to look at loans for non-US residents, because it's very different to if you were on the US soil, and vice versa. If you've got other loans around the world, let's say you want to buy an Australian property and you've got some US debt, US property debt, it is more complex for you to borrow here in Australia. So we've got some specialists within Apt Wealth that on the mortgage side that have a lot of experience in that. And there's some other professionals out there as well that do specialize in that space. So feel free to reach out if if you need some assistance on that side of things. There was the other part of it around. Oh, sorry, Khandra, do you want to add anything on that?
Yeah,
Side?
If it's a U.S. citizen purchasing a property, the sale, it's probably not too difficult. It would be sort of like any other U.S. person selling out any other U.S. property. But I think one thing that often gets overlooked, which is not my area of expertise, but it's the estate tax planning side. So if you are a U.S. citizen in Australia with U.S. assets, I think it is really important to have your estate tax planning reviewed. Make sure that it works from a cross-border perspective, because you obviously don't want your heirs or your beneficiaries to be caught out, especially because I imagine a lot of money is going to be tied up in that property.
Yeah, it's super important. From a cross-border estate planning perspective, to have appropriate, wills in place. I think we've got Elizabeth Michaels on the call. Making sure that the professionals understand US Australian estate planning. Speak to a professional that is experienced with US Australian estate planning matters. Potentially having a will in the US and to cover the US assets, and one in Australia to cover the Australian assets, and but it's certainly speaking to an expert in cross-border estate planning is really important, and having the solicitors actually speak to each other, because there can be some wording within wills that can kind of cancel out the previous will and cause an awful mess. So speak to a specialist, and we know some great ones. So great. So moving on to the next question. So I think we answered in terms of the principal place of residence and the 50% exemption.
Just to quickly clarify that question. So it's a bit confusing, this one, but effectively you need to look at the main residence and investment property different in terms of the exemption. So effectively, if you return to Australia and you're an Australian resident and you sell your Australian main residence, you can normally sell it tax-free as long as that period has been less than 6 years. But the key point would be that you're an Australian resident when you sell the property, versus the investment property, which is a bit different. So that 50% discount is lost for the period you own the property and you're living overseas. So it's basically a pro rata calculation on that 50% discount on the investment property side, which is a different sort of test to that PPR test.
Yeah, and that's a key point, because I have seen some advice out there where if you were to return to Australia, sell when you're back in Australia, that the 50% exemption applies for the whole period. That's not the case, as Brad mentioned. So you definitely be careful there. So that's a really good point there, Brad. So the next question there.
I can jump in there. So I think the context here, we're talking about if you come to Australia and you're looking to sell your US property. I think that's what the question's asking. If I'm wrong, let me know. But I think you need to look at two issues there. Like, first off, for Australian tax purposes, you can normally exempt your US home if it's your US main residence and you have not got a second main home in Australia. It should be exempt under the Australian rules. Secondly, the property also gets rebased to its fair market value when you come to Australia. So that just means that any gain would be on the increase in the value of the US property after you've moved to Australia. But I think really important to consider the US implications that Khandra spoke about before around that.
Yeah, perfect. Thank you for that. I think we're down to the withholdings tax question. Is that?
Yeah, can you read it out, John? Sorry, I don't have.
Yeah, that's right. So it says on the non-US citizen withholdings tax, Khandra was just mentioning. Was that just in relation to a property in the US or a property in
Yes,
Australia too?
real property, so actual physical property. Yeah.
Yeah. Is that in relation into property in Australia too, or is it just the US?
So this
So
would US withholding tax on
Yeah.
US property. Australia does have a similar concept of withholding tax for non-residents who are selling Australian property.
I think the important point too on withholding taxes, right? If they are applied, it doesn't mean it's a final tax on the property. You can lodge an Australian or American return to actually pay the right amount of tax, and if you've overpaid it, you can normally claim it back, or if you underpaid it, you can owe some money. But I think it's important to make sure you get that right before you sell the property.
Well, that's really what it is, right? It's to incentivize or force people to actually sell that return. I think these rules came into place because there were a lot of people selling properties and just simply walking away with all the money. So it's a mechanism that forces you to file that tax return to get any refund that you are owed.
Someone's asked about the listed maximum tax rate. So I'm assuming this is in terms of Australian resident capital gains tax, being the top tax rate of 23.5% if you held the asset for more than 12 months. That's half the gain, because you get half the gain disregarded, and you're only taxed on half the gain at your marginal tax rate. So if you're looking at the total gain, the maximum tax you'll pay on the total gain you've made is 23.5%. You're right in that. It's looking at it's looking at you're only paying tax on half the gain. So now, in relation to the Vanguard funds, that in terms of this PFIC treatment, there's Vanguard total shares and Vanguard All World ex US, which are two that are actually US domiciled. Please check with US accountants, because I've seen plenty still apply PFIC treatment to it, and it's just before you purchase it. And I'm certainly not recommending to purchase it, because that I can't do that in this session to people that we haven't assessed. But check with, and you've got to be careful as well, because a few years ago there was another institution that had a heap of US domiciled ETFs. They moved the domicile to Australia. So keep an eye, because I have had many conversations with Vanguard. I'm apparently the only financial advisor in Australia that wants to keep the domicile in the US, because for everyone else, it's an absolute pain in the neck. But for me and my clients, it works brilliantly. But there is a push to have the domicile shifted to Australia. So at the moment, they're holding off from doing it, but it's something to you really need to keep an eye on. With any of these strategies, with buying US domiciled ETFs from Australia. So there's a question here. So where does crypto fit in to this? It's probably
it's a good question. Yeah, it's effectively taxed the same as a share, Katrina. Yeah. So same concepts, right? If it's crypto you purchase from the US and move back to Australia, it gets that favorable rebasing treatment when you come back to Australia. Likewise, it also forms part of the exit tax when you leave Australia. So really the same as a share from a capital gains perspective.
Yeah.
Mate, Khandra, does it have any PFIC implications in the US?
Not that I'm aware of, not for your typical sort of Bitcoin or sort of the bigger currencies that we've seen. I think, it's definitely an area where the tax offices have not really caught up with the technology, and even I myself, because we're kind of always asking clients, what's the cost basis of this? What's the cost basis of that? And of course, it's difficult to say. I think a lot of the exchanges have gotten a lot better at providing tax documents within your account. So we typically rely on those. But I suspect there certainly will be changes to the way the ATO and the IRS view crypto over time. But we'll have to wait and see what that looks like. Yeah.
I think that there's in terms of holding Vanguard Australian Vanguard shares purchased in Australia, whether to sell them right away.
Mhm.
It depends. It's going to depend on circumstances, so we probably can't advise without knowing a lot more. But that often, avoiding those investments is the best course of action. But there's a question about permanently. So I think this is around Australian tax residency. My reading of that.
Yeah, I'll jump in there, Tracy, because I answered Tracy's question before. Yeah, so normally if you move to Australia on a permanent basis, that's when your Australian residency would commence, from that date going forward. So not for the full income year, but just from that point in time moving forward. It's a great question of when does permanency actually commence. It would really look to in terms of when you make the intention to make Australia, your home through evidence by having a lease in Australia, for example, buying a property in Australia, doing your business from Australia or being employed from Australia. That's when it normally would apply from, as opposed to being here in Australia on a short-term, temporary basis. If you're sort of holidaying in Australia or seeing family or friends and doing a bit of part-time work on a short-term basis in Australia, normally your residency wouldn't start until it was a bit more of a permanent basis in Australia. But good question, and always a complex one too, in terms of when would Australian residency start.
Yeah, I think your marital situation has a lot to do with it as well. And it's interesting, sometimes we see so much difference between the IRS and the ATO view on that, where the IRS has no concept of de facto relationships. So actually our tax residency position can really differ a lot compared to the way that we think about it in Australia, just because you may or may not be legally married. So that's kind of an interesting one for Aussies to wrap their heads around. Yeah.
So there's a question on inheritance as the next one. So inheriting Australian property and shares for the US residents, for dual US Australian citizens from a tax and continued ownership perspective. And this, I think, is from a US, someone living in the US, which is then getting a bit even more complex.
Yeah, definitely seek additional advice in a very simple scenario. So, maybe you got cash from a grandparent who passed away, for example. Typically just a case of reporting the transaction to the IRS on a special form, but really no tax implications. But it can be so much more complicated depending on the type of asset that you inherited, whether there was a testamentary trust involved, whether they're PFIX or not, whether the house was rented out or not. Like it could be quite a Pandora's box. So definitely seek more advice on that one.
I think too, it's a great question. We see it quite a lot. On the Australian side, really important, especially if it's Australian property that's passing to a non-resident living in the US. Basically, you've normally got 2 years you can still sell the property free from Australian CGT, but after that 2-year period, it's effectively taxable. So just definitely bear in mind those timeframes. And the big one too is the shares passing to a non-resident beneficiary. There is actually a taxing point if Australian shares from an Australian estate pass to a US person. So that can be avoided, mitigated through having certain mechanisms in the will in Australia, obviously just to make sure it doesn't go directly to the US person. But it's a complex area for sure. So just make sure you get some advice around that one. And some estate planning as well.
Absolutely. Now there's a few questions about the previous webinars that we did. So we did one about US Australian retirement planning a few weeks back. So Brad, I think you added it to your YouTube channel, the Murphy Tax YouTube channel. So I think if
it's up there. Yeah, definitely. It's on our YouTube channel. Otherwise, happy just to share it with you. If you want to drop me an email, I can email it to you directly.
Yeah, that's right. So everyone in the session will get an email with our contact details. If you can't find it on YouTube, then just drop us a note and say, can you please share, and we'll share it with you. Not a problem. So now, in terms of, a US citizen living in Australia with an Australian wife, is there a risk involved in putting all assets in my partner's name? Is there a US liability for any of the investment gains.
Yeah, I think that's very traditional tax planning, is to have the non-US assets in the non-US partner's name. I suppose if they're pre-existing assets, there's a risk, when you try to transfer those assets, there could be different taxing points in different countries, depending on what the asset is. And then again, the big one there would be estate tax planning. So if you were to predecease your spouse, they would end up with all of the Australian assets in the US person's name. So that needs to be managed as well.
Yeah. The gift and estate tax as well. So transferring assets from a US citizen to a non-US citizen spouse as well. It will lower the threshold for your lifetime limit of gift and estate taxes. Now, that is extremely high at the moment. It's something like 14 million or something, isn't it? US or thereabouts. Most people won't have a problem with that in their lifetime, but they are looking at potentially halving that at some point in years, maybe. But also just bear in mind as well that Australian taxes aren't small either. So if your Australian spouse, is a higher income earner, then potentially you're solving one tax issue, which is the US side of things, but you might be just putting, because typically for a US citizen living in Australia, if you're just looking at the federal rates between the US and Australia, Australia is usually a much higher taxing country. So if your partner is on a high Australian marginal tax rate, there may not be the benefit in holding certain assets in their name. It might actually be better to hold it in a lower taxpayer name, even if they are a US taxpayer. But it can be an effective strategy to get around these issues and other US tax issues, to hold it in the non-US taxpayer's name. But
I think the main residence is probably the best example of that, because the outcome is so good in Australia, whereas perhaps an investment property, you would be looking more towards the split between the high income earner and the low income earner, just as an example.
So if you're an Australian citizen living in the US with permanent residency, and you move back to Australia and sell your shares in the US market, so the permanent residency is the key there, I think. Yeah, Khandra, do you want to maybe touch on that?
Green card, permanent residency, it does tie you into the tax system regardless of where you're living. And we quite often see issues where a green card or permanent residency has expired for immigration purposes. So it does you no good to actually go back to the US to stay, but it ties you into the US tax system. So selling Aussie shares, selling an Aussie home, you are also still tied into the US tax system. So lots of different planning opportunities there, but you need to understand the impact of that green card before you apply, or certainly before you reach 5 or 6 years of holding it.
Yeah, and that really ties into that next question, I think, in terms of the upside and downside of becoming a US citizen. So really the upside is that you've got the right to reside in the US, which is great for those wanting to be able to live in the US without having to apply for visas. So but the downside is what Khandra alluded to, is that you carry the US liability with you wherever you go in the world, and all those issues that we've talked about today, about the primary residence, passive foreign investment company treatment, all of those things come with the US citizenship. But there's more to life than just tax, of course. It's the big thing is the right to reside in the US ultimately, and why many people do keep their US citizenship, even though it makes life in Australia a bit more complex on the financial side of things. The different tax years, how do you reconcile the different tax years? Which is something you guys are,
I think me and Khandra spent too much time looking at this over the years.
This is probably a really good reason why having you guys as working together really closely and speaking to each other, because we see plenty of US Australian accountants not speaking to each other on So yeah, maybe you guys want to go through how you
Yeah.
that.
Yeah. Do you want to start, Brad?
Yeah, I'll start. Yeah, so I think first off, really important to note there's never going to be any double taxation. There's always obviously a tax offset available in one country to offset double tax. But I guess that the timing and integration piece is really important to make sure you're paying the right tax in the right country and the credit's going the right way. And that's where it sort of ties into that, making sure you've got accountants that actually talk to each other and have that experience. But I think to answer the question, obviously there are different tax years between Australia and the US. US being on a calendar year basis, Australia being on a 30 June basis. Normally it works out quite smoothly in that we can, if you've got the Australian return, we can pick up the US income on a calendar year basis and split that for the Australian return and vice versa. What's really important, and Khandra would jump in a second, is just to make sure that if you do, for example, have a US payment due or tax filing due in the US, that you have paid your tax to Australia before the end of the calendar year in the US, and that's where the timing is quite important. But I'll let Khandra discuss that.
Yeah, I think, to the best of our ability, we always try to report things on the calendar year where it's practical and where it's possible. If you have 3,000 interest income entries, we might take a more practical approach at times, but we do try to stick to calendar year. And Brad's absolutely right. My recommendation for Australian tax residents is to have your Australian tax return done before December 31. And like he said, if you need to pay tax in Australia, just get it paid before the end of the calendar year. That just gives you the most options when it comes to reducing the double tax on the US side. I think, the idea obviously in Australia is that you defer filing as long as possible. You wait as long as possible for the ATO to assess you to have to pay the tax. But for US citizens, it can really stuff up your cash flow going forward. So at least get the return drafted early, and you can kind of make an informed decision about whether you need to actually spend the cash or not.
Might have time for one or two more. There's so many questions coming through. Thank you to everyone for sending these through, but just in the interest of time, maybe if you want to pick out a couple more to go through, guys. Any ones that are jumping out at you, or so there's one about that we moved to Australia before we bought a main property. We are Australian tax residents. We work for an American company gaining US tax. Would we want to purchase a property in the US or Australia first?
So just to confirm, John, the question was they've moved to Australia. They're from America.
Australian tax residents. And so we moved to Australia. Australian tax residents work for an American company with US income, and whether you buy property in the US or Australia first. So I guess it probably comes into currency exchange side of things mostly.
I think too, you want to look at your long-term plans too, like where you're going to be living long-term. Is it to live in Australia sort of forever, or the US? And I think it's a great question. I think it's certainly going to be easier getting financing to, like, I guess that's the other point, right? To get financing, getting a loan from an Australian bank, you want to have either Australian, employment or income on an Australian tax return. So just make sure that you've got the tax return file to give to the bank in Australia to get the lending. And John, you can probably jump in, give more context there. But I guess if you buy on the Australian property, it's your main home, it's tax-free in Australia. When you sell it, happy days. It's probably just be aware of the American side, as Khandra mentioned before, that the exemption in the US can be capped, I think.
Yeah, that's right. I think, I don't know that I can comment on the timing. Like, the US rules are the same regardless. If it's your main residence and you've lived in it and own it for 2 of the 5 years prior to sale, you do get those exemptions. But I suppose if you're living in Australia, you're never going to live in that house in the US for 2 out of 5 years. So I think in that sense, you'd buy in Australia, but I might not fully understand the question, but feel free to email me.
Yeah, and
that was
might need some more info.
Yeah.
In terms of the longer term goals, as
Yeah.
Brad mentioned.
Yeah.
Yeah. There was one more good one too. I'll quickly just answer about what happens if you're the beneficiary of a US will or estate living in Australia. That's quite a common issue as well, and a good question. Certainly a complex one as well. But normally, if you're in Australia and you inherit US assets, so US shares, an IRA, 401k or US property. Again, normally good news on the Australian side. Like normally they would come into the Australian tax net for their market value on that date. But certainly a complex area given you're looking at winding up a US trust or estate, and just important to make sure you go through what US is being paid at the estate level and the personal level, and then how that tax credit would apply to Australia as well.
Yeah, and maybe last one here, a quick one. Does the PFIC apply to an Australian who comes back if he still hold US managed funds? No. So passive foreign investment company is very much a US tax term. Australia doesn't care and doesn't have any of these types of treatments. So you can essentially own international managed funds, and that's quite commonplace for Australians. And any US managed funds won't cause this problem, because both from a US side of things, the US again will not have a problem with any US domiciled managed funds, and from an Australian perspective, Australia doesn't have similar rules to that. So there's heaps of questions we didn't get to, and we're so sorry we couldn't get to everything, just in the interest of time. But please feel free to reach out to us. We'll send that email with the recording and all our contact details in the coming days. But thank you so much for joining. You're welcome to reach out to us and inquire about our services, and keep an eye out. We'll keep running these sessions in the next little while, and we hope you've enjoyed it. Thanks Brad and Khandra as well. Thanks for joining.
Yeah, thanks everyone for having me. Thanks, John, for setting everything up with your team as well.
No worries.
Yeah, thanks, John. Thanks for having us too. And obviously there's a fair few questions there that weren't answered, so feel free just to drop me or Khandra or John an email, and we'll come back to you. Yeah.
Have a great evening if you're in the US, and have a great day for those in Australia, and look forward to seeing you next time. Thanks, guys.